Hello and a warm welcome to the La Trobe Financial Investor Call for August. I'm Lillian Chin, Director of Client Partnerships at La Trobe Financial. Thank you for joining us today. We currently live in interesting times. A raft of lockdowns and restrictions continue to impact the lives of most Australians. And yet, among all the noise, we are seeing rebounding economic growth, surging property prices, and low unemployment. Has there ever been a stranger time for investors seeking low volatility income? Of course, having rebounded so well as a nation from the 2020 lockdowns, we are well placed and better equipped to deal with economic impacts of lockdowns today. Even the usually circumspect Reserve Bank has stated that the recent lockdowns have been less damaging to the economy than the lockdowns of the first half of last year. Among all of this, investors find themselves in an environment of ultra-low interest rates and continuing market volatility. Self-directed investors and retirees who paid off home loans with interest rates near 20% per annum are now trying to meet income and lifestyle needs with investment rates near zero. These are challenging times. At La Trobe Financial, we are leaning in to assist with a range of products to suit a variety of income and duration appetites. So again, thank you for joining us. In this update, we will look at what really matters right now, the key drivers of the economy and property markets we are all navigating together. We will also update you on the performance of the business and our award-winning credit fund, and give an overview of our range of products. Today, you'll be hearing from key wealth management executives. Troy Stratton, our Deputy Chief Investment Officer, has 20 years experience both in London and here in Australia, across banking and wealth management. Troy has worked in senior roles with Barclays Wealth, Barclays Private Bank, and HSBC Retail and Wealth Divisions. Michael Watson, Head of Distribution Asia Pacific, has been with La Trobe Financial now for a decade and has worked within various market-facing and project roles. Michael's background is 20 years as a credit investment specialist, spanning credit analysis, portfolio management, operations, and investor services. And finally, to me as Director of Client Partnerships. I have over 21 years experience in the domestic and international private banking industry. My roles have included regional executive at Westpac Private Wealth and working for Merrill Lynch, HSBC, and Citibank in Singapore. Let's begin with a brief corporate update. The La Trobe Financial Group is Australia's leading credit asset manager. We commenced operation in 1952, have 13 billion in assets under management, and employ over 440 staff here in Australia. Secondly, our business has two key growth engines. Our asset management business is spearheaded by our 6.3 billion credit fund, which has 55,000 investors and operates in the $3.3 trillion managed fund sector. Our real estate credit finance business draws on our deep expertise in credit to deliver one of the broadest mortgage product suites available in the 2.4 trillion residential and commercial mortgage market. Both markets have enormous depth and diversity and offer tremendous opportunities for us to grow and strengthen our offerings. Finally, we are a portfolio company of the New York-based Blackstone Group. Blackstone has over US $684 billion in assets under management and own 80% of the business, with the remainder owned by senior management. Blackstone's global network of businesses gives us real-time insights into market trends that complements the insights we derive from the circa 13 billion in assets we originate annually. A key point of difference for our business is the diversity of our investor base. We have an unparalleled funding book spanning the world's largest banks and financial institutions, with whom we have 3.6 billion in mandates. Debt capital markets. We've issued almost 8 billion in RMBS bonds and, of course, our 6.3 billion credit fund. This profile is unique in the market and allows us to capitalize on growth and portfolio opportunities beyond those that our peers can pursue. And that's to the benefit of all our investors. While we're on the topic of debt capital markets, La Trobe Financial last week settled a 1.25 billion RMBS issuance, further demonstrating our unique and diverse funding program. The transaction was completed with repeat support from domestic and global investment houses. In fact, we now have a range of 53 local and global institutional investors in our RMBS program, from local fund managers, banks, international banks, and large pension funds. In this particular transaction, 4 were from Asia, 2 from the United States, and a further 2 from Europe and the UK. Indeed, the hunt for yield globally is as strong among institutional investors as it is amongst everyday self-directed investors and retirees. So much so that portions of the transaction were 2.5 times oversubscribed. Further endorsement of our high-quality assets, expertise, and long, consistent track record as Australia's oldest diversified asset manager. With that brief overview of our business and funding, I will now hand over to Michael Watson, who will give us an update on the economy.
Thanks, Lillian. Hello all. If you viewed our webinars or read our monthly updates, you'll be familiar with our long-held view that the road to economic recovery from COVID-19 will be bumpy. To date, the Australian economy has demonstrated remarkable resilience, steeled by low unemployment, a surging real estate market, and a raft of economic indicators coming in above expectations. Yet, the spectre of pandemic risk has loomed as an ever-present threat. With major Australian capital cities and regional areas presently in lockdown or with restricted borders, it's clear that elevated pandemic risk will remain with us for some time. Of course, the vaccination program is offering some hope, but there'll be false starts and periodic lockdowns remain our reality. Outside of Australia, key economies with strong vaccination numbers are reopening, and we're seeing the initial move towards a restructuring to a new normal. Any new normal will certainly be against the backdrop of residual pandemic risk. Let's take a look. The quote on this screen is a particularly relevant statement coming from the Reserve Bank of Australia's August Statement of Monetary Policy. The full quote mentions that business models have adapted to restrictions on activity, and the restrictions themselves have generally become more targeted now. Also, that the past experience has shown that when the virus outbreaks are contained and restrictions are eased, spending bounces back as consumption possibilities return. Economists generally remain bullish. Most still believe employment will be below 5.5% even by December this year. This is a massive vote of confidence for the resilience of the economy. Inflation is still expected to return, albeit off a low base, and house prices, as we'll discuss shortly, are still forecast to rise against the backdrop of restrictions. Consider where we are right now against where many thought we may have been. In the mid last year, it was commonplace to see projections of 12 to 15% unemployment and house prices down by 20%. Unemployment is now at 4.6%, and as we'll see shortly, there's been a surge in house prices both here in Australia and indeed around the world. Of course, this presentation is going to air at a time when a large proportion of Australia is currently in lockdown. We're certainly not finished with the economic effects of the pandemic yet, and we'll continue to watch a range of headwinds and tailwinds very closely. On that note, let's now turn to our headwinds and tailwinds report. A headwind that may cause some serious drag on the economy for some years is the impact of closed borders. It's forecast that by 2031, Australia may have more than 1 million fewer people than otherwise would have been the case. Population growth is a driver of economic activity in any country, and strategically important with our demographic tilting towards an ever-ageing population. In addition to the potential impact on housing prices, the extent that these population forecasts prevail or are addressed could have long-lasting impacts on our economy and our standard of living. Immensely topical right now, the pace of Australia's vaccine rollout presents another key economic headwind. An unvaccinated population is prone to lockdowns under our nation's existing strategy and restricts businesses from reopening or forward planning with any confidence. The number of vaccines administered is growing rapidly, however, continues to fall short against the federal government's earlier objective of 20 million Australians vaccinated by October 2021. While noted as an economic headwind, a positive consequence of our slower vaccination rollout could be our ability to observe the health outcomes that highly vaccinated jurisdictions experience while reopening their economies. Lessons from these locations in the coming months may be valuable to our own longer-term strategy and public health results. Currently, each state is formulating approaches to reopenings and restrictions based on percentage vaccination numbers. We look forward to these being finished and finalised as the vaccination rollout gains speed. As we're experiencing presently, the go-to government response in lieu of a highly vaccinated population is rolling lockdowns. Indeed, every mainland Australian state has experienced some level of lockdown over the last 6 months. While effective for ultimately quashing outbreaks, these lockdowns do have distinct and immediate impacts on economic activity. We'll continue to watch closely the impact of the current lockdowns on economic activity. Another consistent economic headwind is the ongoing Australia-China trade tensions and their potential for impact on our economy. So far, the overall impacts have been muted. The surging demand for iron ore sees both our overall trade balance on a positive trajectory and at all-time highs. While the aggregate trend may be positive, the sector-by-sector impact of tariffs and ongoing restrictions have delivered targeted blows to our economy. To date, individual sectors impacted by tariffs or bans have seen disruption, but have managed largely to source alternate destinations with new trading partners. The challenge for our economy, longer term, will be to manage this key relationship better and to better diversify our export customer base. Let's now move to tailwinds, those factors which we anticipate will drive the performance of the economy in the period ahead. Starting with the macro commitment to expansionary policy settings. In 2020, we saw the success of fiscal policies such as JobKeeper and JobSeeker in maintaining employment and sustaining businesses. Together with monetary policies from the Reserve Bank, including maintaining low interest rates until at least 2024, we had a unified position of significant support. Importantly, this support has continued. State and federal governments have launched tailored, targeted mechanisms to support individuals and businesses. The Reserve Bank has reaffirmed its low rate settings and provided clear guiding objectives. Even as recently as August, the RBA board confirmed its commitment to supportive monetary conditions. With the federal and state governments all in, and the Reserve Bank of Australia all in, this presents a real economic tailwind for the Australian economy. Australian households at a macro level are at their strongest ever cumulative net wealth position. Investment in financial assets and rising property prices have seen wealth grow, with only a minor impact from COVID-19. Importantly, the underlying liabilities have been stable. This is genuine, unleveraged wealth creation that puts Australian households in great shape. A consequence of a lockdown economy, maintaining unemployment, but with a restricted opportunity to spend, has been a spike in household savings ratios. This spike, which has begun to normalise, has Australian household balance sheets in great shape and provides a twofold benefit or tailwind to the economy. First, high savings levels provide households with a cushion against future volatility, and this is hugely important as we navigate our way through this current period. Secondly, as saving rates normalise, this will ultimately manifest in a wave of consumption, supporting further growth in the economy. Unemployment numbers have been a standout data set of the last 12 months and have continued on that strong performance. Where multiple commentators had anticipated double-digit prints, unemployment peaked at just 7.4% before receding swiftly. It's now at the extraordinarily low rate of just 4.6%. An employed population, of course, has multiple benefits: consumption, confidence, and of course, for governments, each employed person represents a taxpayer contributing to national revenues. It's a testament to the robustness of the entire economy that unemployment is also uniformly low throughout all states and territories. These low numbers represent people in work right across Australia, earning incomes and supportive of all the local economies around the country. We'll see a bump up through lockdown, but experience so far points to a rapid snapback in employment as lockdowns end. And for the final tailwind, we take a look abroad to the impact of lockdowns on economies around the world. The chart on screen tracks the average change in retail and recreational movement in different countries and different economic growth of each. There are a couple of points of interest on this chart. Firstly, Australia has experienced relatively light lockdowns compared to most other countries. Of this cohort, only South Korea, Sweden and Japan have had shorter net lockdowns. Secondly, of these 16 countries, Australia enjoys the highest current GDP numbers, closely followed by the cohort of countries that avoided longer lockdowns. So while we saw that targeted lockdowns dent economic activity, we surmised that shorter-lived lockdowns allow economies to reopen faster, and that's better for all of us. So that's our headwinds and tailwinds report for the month. Overall, we continue to see a much stronger outlook for Australia than most global peers. Of course, no commentary on the economy will be complete without a look at the residential property market. As we've touched on in a number of our recent webinars, the property market has seen a surge in results right across Australia and is a clear example of just how robust this asset class can be. Let's take a look at the current state of play. Most are aware of the surge in residential house prices over the past 12 months. Residential property grew by 16.1% year on year nationally over the 12 months to 31 July 2021. It's still growing at a rate of over 19% per annum. Every capital city has recorded double-digit growth, and with the exception of Perth, which had recently experienced growth for the first time in some years, each capital city appears to be on a strong trajectory, even against a backdrop of lockdowns. Residential property price growth remains buoyant. Annual sales volumes remain strong, still well ahead and above the 10-year average. The much talked about canary in the gold mine of auction clearance rates remains high. It's off from the highest level, but is still above 70% across most jurisdictions and circa 75% nationally. And ultimately, growth in prices still remains uniformly high across both metro and regional locations. Growth is below the peaks witnessed back in March, but the double-digit growth in all capital cities and a market growing at nearly 19% per annum is by no means one I would call cooling. This final slide on the property market takes a look at the market dynamic to get a gauge on the direction of the market. Currently, it's supportive of continued price growth with a fundamental reason: demand and supply. In recent months, you can see that both new listings and total listings have fallen. There's not a huge amount of new stock on the market, meaning total market stock is low. On the flip side, demand for property has held steady from its post-COVID surge. The net result is that demand continues to outstrip supply, and in any market, that will ultimately drive the outcome. With that look at the economy and the property market, let's now turn to Troy to review and give our monthly portfolio update.
Thank you, Michael, and hello all. I'm excited to provide our monthly product and portfolio update. Pleasingly, the theme among our portfolios for July was one of continued growth and resilience. Let's take a look at some key factors now. Let me start with an overview of our investment offerings. You can see on screen our full product suite. All of our distribution rates are variable, which are reviewed monthly. All of our products have strong track records of performance since inception, and as an asset manager, we are dedicated to providing investment products that help deliver regular income to our investors. With interest rates remaining at historical lows and inflation becoming a talking point for future considerations, a targeted exposure to our investment accounts could add real power to your investment portfolio income profile. One key difference investors will notice here is the launch of 2 new portfolio accounts. To assist in offering quality inflation responsive alternatives for investors, La Trobe Financial has recently launched our 6-month notice account and our 2-year account. Both accounts have invested into the same high quality asset class familiar to our investors in all other accounts, while adding new investment timeframes and return profiles. The new products are available now, and you can review these in full in our updated PDS dated 10th of August, which is on our website. Investing into our new products is easy. It's easy through our online La Trobe Direct portal or by completing an application form at the end of the updated PDS. Of course, if you have any questions about any of our investment offerings, please don't hesitate to contact our friendly private wealth team on 1800 818 818. Let's now turn to the asset quality profile. After all, it is the assets in the fund that ultimately drive the performance for investors. The quality of our asset is what we are known for, and we are acutely and utterly focused on maintaining the very highest standards of investment and portfolio construction discipline. On screen, you can see the asset quality has improved materially as our business has grown. In June 2016, prime and super prime assets, or the highest quality loans we invest in, were 28.2% of the portfolio. And at the end of July this year, that had grown to 37.4%. Conversely, the higher yielding but riskier specialist assets were 19.1% in 2016. They are now below 9%. That's an impressive 50% reduction. Another key comparison I'd like to draw your attention to is the credit quality of La Trobe Financial borrowers compared to our peers and the Big Four banks. While we have always undertaken rigorous, hands-on credit analysis of our borrowers, we also undertake a credit check from third-party credit analysis provider Equifax. Equifax is an independent provider of credit searches and reporting in Australia, and among other things, provide a credit score for all borrower applicants. As can be seen by the graph on your screen, our borrower credit scores have sat around the levels seen by the banks. And notably, in January 21, our average credit score even surpassed that of the Big Four bank average and has since maintained that or above bank credit scores. This is a powerful evidence of the continued discipline and focus we place on borrower credit quality, and an easy gauge for investors to the quality of the assets that underpin our $6.3 billion credit fund. Let's now turn to the geographic diversification of our fund. Geographically, our focus continues to be on the key population hubs around Australia. Major city and eastern seaboard exposures are central here. Our portfolios are overwhelmingly in metropolitan locations in the major population centres, and that will continue to be our strategy for the foreseeable future. It is also pleasing to know that the percentage composition each state represents within our investment accounts has also remained relatively consistent over the past 12 months. Those of you who have been following these webinars over the last 12 months will know that we very deliberately tilted our portfolios to residential loans through the COVID-19 period as an additional overlay of conservatism. This helps manage the investment risk for investors after all. That served its purpose very well, and we're certainly happy now to see our commercial exposure starting to rebuild. Note, however, that our portfolios are built bottom up on an asset-by-asset level. That means that portfolio holdings move very organically, and it will be some months before you would expect to see any substantial change in our portfolio holdings or trends. And we are super comfortable about that too. We've had some questions recently around inner cities apartment exposure, so you can see on screen now that they are not material exposures for our portfolios. After all, we've never really been a big lender in that space. In addition to asset quality and geographic diversification, we're also focused very closely on liquidity management. Moving to an overweight cash position was a very deliberate strategy when the potential impact of COVID-19 became clear. We still maintain elevated liquidity holdings, particularly within our shorter dated classic and 90-day accounts, and we are very comfortable being there. We are very aware that we operate within an environment of elevated pandemic risk. We took an early view that we did not want to be rushed into the reinvestment process. This ensures a practical and pragmatic approach to reinvestment is maintained and allows us to continue to watch the macro, the market and geopolitical developments closely to ensure we have plenty of tactical optionality in our liquidity positioning. Noting the environment of elevated risk and uncertainty we operate within today, this prudence would appear eminently sensible. It is also worth noting that we remain one of the very few funds in the sector that have always met redemption requests in full at maturity, and we are entirely focused on retaining that track record across all of our offerings. If that means we are still overweight in cash at times of uncertainty, then we're very happy holders of that position. Let's now turn to the performance of our borrowers. Our portfolio managers have retained the discipline of reporting on the loans in our portfolios that are under pandemic-related hardship arrangements. You can see that each month in our snapshot and metrics report. For consistency and absolute transparency, and noting the potential for impact due to the extended lockdowns in Sydney and Victoria in particular, we will continue to include hardship as a discussion in these updates. In short, in 2020, hardships peaked and receded swiftly, with no one sector or location overrepresented in our statistics, demonstrating strong borrower cohorts right across our loan book. As at the end of July 2021, across our entire fund portfolio of 9,957 loans, just 30 are in hardship. Just as pleasingly, the transition from hardship to arrears has also been well ahead of our expectations. Arrears levels have continued their declining trend and are now operating around long-term low levels across our book. The especially pleasing part of this is that the new arrears loans are exceptionally low levels. That's a testament to the resilience of our borrower cohort, the robust credit assessment practices, and also the strength of the economic rebound post-hibernation. We anticipate no material changes to these numbers, and to date, since the beginning of these lockdowns in Sydney and Melbourne in particular, we have not seen a noticeable increase in either arrears or requests for hardship assistance. Of course, we will continue to report on borrower hardships as a line item in our monthly portfolio snapshot and metrics, as I just mentioned. Our mortgage help team will also be there, working closely and sensitively with these borrowers who are impacted by current market circumstances, but are very mindful of the objectives to protect investor capital. And the final point to bring to your attention is asset shortfalls. The table on the bottom of the screen shows asset impairments or shortfalls across the fund portfolios at well below long-term averages. That speaks to the quality of the book. While the first year numbers can move around a bit, the year 3 numbers are a reflection of the quality of the assets in the book. To put this into context, that represents only 3 cents for every $100 of loans in the 12-month term account has resulted in an impairment loss within the investment account. This is truly remarkable indeed. Finally, the bottom line of how a credit fund has performed over time. During the month of July, the portfolios continued to perform above benchmarks. This again is a consistent outcome since our inception of our asset management operation. This consistency of performance can be shown in the graph on your screens, which shows the performance of $100,000 invested in October 2002 and compares it to a range of asset classes. The dark blue line is cash, green is property securities, purple is bonds, red is global shares, grey is Australian shares, and light blue as our very own classic notice account. The thick orange line in the middle is a 12-month term account, which started in October 2002. The returns that it has delivered have been strong even in absolute terms across the 18 years period in which it has been operating. Its performance is incredibly consistent or low in volatility. It simply keeps on performing month in and month out and producing monthly income yields above market for investors. That's important because it takes the question out of having to correctly time the entry into the market off the table. And timing can make a real difference for most asset classes. Additionally, it's worth noting that our classic 90-day, 12-month and 4-year accounts continue their flawless track record. None of these accounts have ever lost a cent of investor capital or missed a distribution. None of them have ever failed to pay an investor redemption at maturity. That's the performance profile we have designed over 7 decades for investors. And of course, final reminder that we are looking to continue this stellar performance in our new 6-month notice and 2-year accounts. With that look at product and portfolio, let me hand back to Lillian. Lillian, over to you.
I hope we have been able to offer some insight into the current economic environment comprising low interest rates, high market volatility, and the pandemic. We certainly live in interesting times. Throughout, as it has done for 7 decades, La Trobe Financial is leaning in to help with low volatility income investments that make a real difference to portfolio outcomes. Thank you for watching our August investor call. It's our pleasure to be able to assist you with your investments. If you would like to discuss your investments with us or speak to us on any issue, please contact any of our friendly investment team on 1-800-818-818. On behalf of all of us at La Trobe Financial, we wish you a great month ahead.